Hello and welcome back to Learn It from a Layman. I am Carl Christensen. I am joined today by Jared Miller. Jared, I think you have some type of letters before or after your name.
Oh,
Is
no, not yet.
oh,
We're
okay.
we're
All
still
right.
working on that
But
officially, but yeah.
okay, right. But so you do the work of so today we're going to be talking about the basics of CFOs or chief financial officers and all things like financial related in companies. So Jared here has a ton of experience. And what's your degree in, Jared? Like, what are you working on?
Yeah, so I have a bachelor's in accounting, and I'm working on a master's in accounting with an emphasis in tax. So that where I currently live in the state of Utah, in order to sit for the CPA exam, you've got to have your master's. And so I'm working on my master's so I can sit for the CPA exam, just to have,
Nice.
as you mentioned, those three letters after my name.
Okay, and that's CPA. What does that CPA stand for?
Certified Public Accounting. Or
Oh,
accountant, pardon me, not
okay,
accounting. You'd think
got
I'd know, but
it. I don't know. You get just once it turns into an acronym, it's just the acronym. So,
yeah,
um,
honestly, it is.
okay, cool. All right. So, how long have you been working in the financial area?
Yeah, so it's been pushing 15 years, not quite there. I think it's like 13, almost 14, but I round up as we do in accounting. We
Right.
round up to prettier numbers a lot of times. So
That's
working
right.
towards 15 years.
Okay, cool. Um, all right. Well, so we're going to just dive in. So, obviously, basics of that you obviously have a lot of experience in the area, but we try to kind of keep it pretty surface level with maybe a few more in depth, just exploratory in some of these areas. But
Yeah.
so, first of all, uh, what's the difference between an accountant and a CFO?
Yeah, so they're both going to work in. Frankly, there's a lot of similarities. I used to work as an accountant. That was my title, senior accountant, general ledger accountant. You'll hear those titles or accountant. In fact, even though I work as a CFO for clients, I often just say I work in accounting because a lot of people don't know what it is if I go into too much detail. So
Right.
you're basically looking at kind of like your troops and your general, I guess, if you wanted to put it in military terms. Your
Okay.
troops, your accountant are your troops, to the people doing a lot of the work. Your CFO would be your general, leading the troops, making decisions, working with other, liaisoning with other departments within your organization, be it the CEO, uh, your sales, your marketing, your operations, your manufacturing, depending on the type of company you're working in. So they help bring the picture and then bring insight into the company, but then also help lead the accounting department. And also, a lot of times, the funny thing is, it's a little weird. You have CFO, it's Chief Financial Officer. You also have the finance side of the accounting. The kind of best way to describe it, accountant or someone working in accounting is a kind of a historian telling you what's happened in the previous month, the previous day. They record the financial transactions of the company. In finance, you're future looking. You're trying to use data that you have access to future look forward to predict and plan what can happen. So the chief financial officer in most companies will be ahead of both of those kind of functionalities. In some organizations, smaller or mid-range, there's a lot of cross functionality within that. So that's kind of why you hire CFO. Kind of a little
Okay.
weird. More oftentimes, you'll also in some companies you'll see CAO, which is chief accounting officer. So in some organizations, they actually separate both of those functions and
Okay.
strictly accounting and strictly financing. But very rarely do you see that.
Interesting. Okay. And so you've already mentioned like a bunch of the things that a CFO might do, obviously in the different kind of departments that they or different employees that they would be in charge of. But like
Yep.
on a day-to-day or even a week-to-week basis, what does a CFO do? What are their job
Uh,
responsibilities?
biggest thing is you're responsible for the financial health and effectiveness of the company. To kind of put it there. In most companies where you actually need a CFO or you have a CFO, it's a corporation. You'll have a board of directors. even if you don't have a board of directors, there's someone that you're responsible to, be it the owner, the shareholders, the board of directors. Uh, I mean, even if there's a board of directors, ultimately they're representing the shareholders in that point. So ultimately the shareholders, but you're meeting with them. You're making sure that you're meeting your goals. You're setting goals. You're working with other departments, like I said, to make sure that they're doing their part and they're reaching their goals. You're holding people responsible. There's a lot of um, I guess you could say where other people dream, we kind of help them bring back to reality. Sometimes I feel like
Sure.
everyone wants to spend lots of money and says, if you give me more money, I could do it. And you have to be the gatekeeper of the money and say, no, we don't have the budget for that. We don't have the cash. Hey, you didn't do what you were supposed to do. So because you didn't go make the money, now you can't spend the money. And so a lot of times we are a reality check too for some companies. It's kind of a harsh thing, but we kind
Right.
of
Right.
keep it grounded. Just a saying is cash is king, and so biggest thing as CFO is cash and making sure we can uh, afford the operations and that we're making cash.
So when things are going well for a company, the CFO is like the hero, the good guy.
Yep,
When things are
yep.
going bad, you're the
Yeah,
bad guy. Right.
accounting and CFO, I say I'm going to use the term accounting a lot of times, just broad sense, just heads up. Accounting can get kind of thrown under the bus. We
Yeah.
can kind of get blamed for things when the board of directors, and it's because we're a good storyteller. Not in the sense that we make things up, but there's always stories behind the numbers. And so as a CFO, you have to go collect that story. You can't just live in a pigeonhole or under a rock or
Right.
pigeonhole yourself. You've got to go talk to, hey, marketing, hey, sales, hey, operations. What happened? Why did what happened to this equipment that it cost an extra $10,000 this month? Oh, someone put a shoe in it and it broke it. Like, okay, well, why did we do that? What happened? How are we going to make sure that doesn't happen again? Um,
Right.
in my career, I've challenged a lot of people too. That's kind of what a CFO will do, is just kind of say, hey, you know what? These are the laws, rules, regulations of the company, and I'm going to hold you responsible to it, because if I don't, no one else will.
Okay. So with CFOs, are most CFOs? I mean, I'd imagine all of them, pretty much all of them, were once accountants. Is that true?
It is not true.
Okay.
It depends. It's going to depend a lot on the size of company and how the industry is. You'll see some shifts or kind of a preferences at different times. Sometimes it's more of a management and finance person, someone that doesn't actually come from an accounting background, but they came through finance, financial planning and analysis, and doing that side of things. Or
Mhm.
they might have a background in management/finance. Other times, people want really good accountants, and I want you to have public accounting experience, which boils down to you usually worked for a large public accounting firm and did lots of audits, and they want you to have your CPA and different things. There's a lot of things. Those are kind of general, but then you could get even very specific of what that specific company is going through at that time. If they're trying to grow, if they're trying to sell, you'll look for a different type of CFO to help lead and guide that. If you have a CFO that has a lot of investment relationships and you're trying to find investors, that's probably the type of CFO you'll want to hire, because they know how to go find you money to build your company. If you don't need that, but you're a public company and you have to deal with the SEC and filing all the legal documents and everything, you'll probably want a CFO that has some experience doing that to make sure that you're following the regulations. So just depends, really. Like
So you mentioned.
I myself started off as in accounting. I started off as an AR clerk. It's not very typical to work your way through. They usually have a different path, to be frank.
Right. So you mentioned like you're trying to get your CPA. You mentioned that some CFOs do have their CPA.
Yep.
Are there other like credentials and other like do some have their MBA? Like are they more like
Yep.
business
Yep.
oriented CFOs?
Yeah, so you'll have some that maybe have a finance and accounting or a bachelor's in finance, and then they went and got their MBA. Yes, that is not an uncommon thing to see.
Okay.
Um, they like to see like either you have an MBA or CPA or a master's in accounting, just something oftentimes, um, just because it you know typically means that you have a little bit more experience and knowledge of trying to lead a company, and not just I'm an accountant and I can record transactions.
Right. Right. Okay. All right. We're gonna jump now. So Jared and I worked together a long time ago,
Oh
like
yeah,
quite a
that's
long
right.
time.
Yeah, it's been a while now. Before
Been
I got
quite a
into
while.
accounting, actually, so it's been a
Yeah.
while.
Yeah. Exactly. Yeah. And I remember. So that was my first like kind of corporate job. I think I taught some places anyway, but that was like I remember in the break room they'd post like our like monthly revenue on like the board or something like that.
Yep.
Um, and that was kind of my first exposure to like financial situation of a company and stuff like that. So let's give a little background, given that was my first exposure, and that's I've only gotten slightly deeper than that since then. What is a company's revenue? How is that calculated?
Revenue, also sales or income. You'll hear all those three kind of in sales. Basically, what money did you bring in for that month or that given period for what your product is? So, uh, I think at BYU, I think it's birdhouses. Very common example back in the day. Say you sell
Right.
birdhouse, you sell birdhouses.
Yeah.
If you sell every birdhouse for $100 and you sold one for that month, your revenue is $100. That's simple. The funny thing is, even that can be complicated because just to kind of get into the part, a lot of times you'll get into what's gross revenue or net revenue.
Right.
Which to explain, this might be getting a little too deeper, but gross revenue would be, hey, I sold a birdhouse. It retails, or the I typically sell it for $100, so that's the gross revenue is $100. But when I sold this one, I sold it at a discount. I gave someone a coupon for $10. So your gross revenue would be 100, and your net revenue would be that $100 less or subtracting of that discount of $10. So your net
Mm,
revenue would be $90. Um, a lot of
okay.
times when people are trying to uh, hide things, they'll give you a gross revenue. Nah, I know it sounds funny. They'll give you a gross revenue number. So it's kind of important to ask like, hey, is that a gross or a net?
Mm,
And
okay.
because you can say like, hey, my gross is $100, but if I discounted it $90, my real revenue is only 10. Like I really didn't make $100 on that birdhouse. I made $10. So
Right.
it's
Right.
a way in the industry to make yourself sound, or not in the industry, just in the industry, but and speaking of finance, that you
Right.
can kind of hide the reality of things, which is
Right.
never good. So I always try to say, be very clear that my numbers are net revenue because those are more real, if you can say that.
Yeah. 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 Clear cut. Um, Speaking of not clear cut, or at least not to the layman, okay, so on that same board, Jared, where we used to work, the I think it had I think it was the same graph but like a different line. So there was revenue and then there was earnings. But I feel like, and once again, this might be the layman and like the child and zero exposure to your world, really. But like I feel like nowadays I don't really hear about, at least in my company and other companies I've heard of, not direct earnings. It's more EBITDA,
Okay.
which
Yeah.
which to me was a completely foreign term when I heard it first a couple of years ago. I was like, they're just making up words now. Um,
Yeah.
so, what is EBITDA, and has it been around a long time? Have I just been completely unaware?
Yeah. So it has been a long time. In preparation of this, you frankly you gave me this question. I'm like, man, I don't know. I've just known about it, and so I actually looked it up. I'll have to admit of when this came into popularity, and it was back in the '80s
Oh,
when
dang.
there was
Okay.
a lot of leveraged buyouts, is what it was called, what it said, and I can explain. Leverage buyouts is basically you're using someone, you're getting a loan to buy something. You're using someone else's funds to go buy
Okay.
something. You don't actually have the capital. Um,
Right.
so we'll kind of get back into that, but I can explain what EBITDA is.
Yeah.
It's an acronym, so each letter stands for something. It's earnings before interest, taxes, depreciation, and amortization. It's
Somehow
so
less clear now.
yeah. So basically, most people have heard of like net income or income. That is your
Right.
bottom line. Like, hey, what did I sell? What did it cost me to sell that? All your expenses of your employees, your rent, your utilities. You get to the bottom line, which is also another term that they use, your net income. And you're like, oh man, got $1,000 at the end of the month.
Right.
Um, Now let me rephrase this. You have $1,000 of income, not necessarily cash at the end of the month, because frankly, there's an actual difference between cash and net income, which trips some people up too.
Huh.
But so what they're trying to say is, okay, well, that's my net income. I want to get in a better idea that what does it really cost? So interest is earnings. So we'll go with earnings before interest. We know what interest is. If you have a loan, you're paying, it's the fee to borrow that money. Essentially, that's what interest is. So they're like, okay, well, I'll have a different interest, or maybe I won't have interest. So let's remove that. Taxes. Okay, well, I know people pay taxes, but that's only if you make money. So let's take out taxes. Depreciation and amortization get a little weird because it's following GAAP, which is generally accepted accounting principles, and depreciation and amortization aren't are a little harder for some people to understand because it's not actually cash expenditure that month. What happens is if you buy something like say a car and you use it over time, you can't even though you purchased and you paid the cash that you bought up front. That happened a long time ago, maybe last year. But because you used it this year, that truck or this month, that truck isn't as valuable as it was at the beginning of the month. So you're saying, oh, well, I kind of lost value. And so you have to expense it. You have to put it on on your profit and loss or your income statement and kind of remove that. And because those kind of add some funkiness to it, they're like, well, let's just remove those. So we get a better idea because if we come in, because the whole idea was if I come in and buy this company, my interest, my taxes, my depreciation, and amortization are all going to be different than what this company does. So let's get to kind of like an operating net income, which is another term. It's kind of like before all this extra stuff that has to go in, what did it cost me in cash? That's kind of what they're trying to get to. It's really weird. I frankly have a love-hate relationship with it because I understand what they're looking for,
Right.
and but just like anything else, if all you do is look at EBITDA, there's ways to fluff your EBITDA and make it look really good.
Right. Right.
So
Yeah.
I, I
Yeah.
I tend not to just rely on EBITDA. It's one tool in the bag of a CFO, I guess you could say.
Okay.
And
Sorry, I wasn't clear on what amortization is.
okay,
Like,
start. Yeah. So depreciation and amortization are very similar. Depreciation, in a simple term, is the cost to use an asset that you purchased. Because
okay.
you're so like if you buy your truck, everyone knows you go buy a new truck, you drive it off
Hmm.
the lot, it doesn't have the same value anymore.
Right.
Correct? Does that make sense?
Right.
So
Yeah.
every month you use something, every time you use a truck, it's not worth as much. So you have to
Right.
kind of expense the use of that truck to show that, oh, even though I have this truck and I bought it at $100,000, well, I've used it a lot, so it's really only worth $50,000. So you're kind of you expense it on your income statement. Does that make sense? I don't know. It's a little
Yeah. Yeah.
convoluted. And
Okay.
then
So yeah.
amortization is very similar, but amortization a lot of times is based off of like say you bought a license to a piece of software that you use for 1 year and it cost you $12,000 each month. You amortize 1,000. They're very similar. They're just on
Uh-huh.
different types of things. Depreciation is usually on a fixed, like tangible asset.
Okay.
Amortization is on usually intangible assets, which is which is the term in accounting.
Ah. Okay. That
So
makes sense.
yeah,
Yes, I like that explanation. Good.
it's yeah, it's a pet peeve of mine. I'm like, I don't know why we had to make it more complicated. They're the same thing. There is some nuances where they are different. I'm not going to get into those, but for practicality, they're the same thing.
Right. Okay. Okay. It seems like for different like kinds of companies, different like verticals, like an EBITDA would have different meaning, essentially, like
Yes.
places that, right, like some that were going to have significantly higher EBITDA, but because they use a lot of things that depreciate a lot,
Yep.
they that would actually, like their after depreciation and amortization earnings would be much lower.
Yes,
Am I
you're 100% accurate on that. So different industries have different kind of standards, I guess you could say. There's not really standards, but kind of generally accepted uh averages. So like a lot of times you'll hear EBITDA in either like the dollars and percentage. You're like, it's $1 million EBITDA. You're like, oh, that sounds good. It's 20% EBITDA. You're like, oh wow, that's really good. Well, 20% EBITDA for a manufacturing company, frankly, is amazing and like can be really hard to obtain. But
okay,
in another industry, you're like, and I can't, for some reason, I can't think of another one off the top of my head. You hear
software?
20%. Yeah, you hear, yeah, I don't, software is a little different, but yeah, you might hear
Okay,
20% EBITDA and you're like, oh, wow, that's really bad. So
okay,
you have to be very, um, yeah. So like,
knowledgeable.
yeah, you
Uh,
have to know the industry. If you're not
right.
familiar with the industry, you're frankly not going to know it. And sometimes there's a little barrier to entry to gain that information. You just kind of have to have experience and ask the right people. Frankly, I don't know what's general in all industries, but the industries that I work with and a lot, it's kind of like, okay, yeah. Um, Double digits EBITDA usually is pretty good in most industries, though. If you're hitting double digits, you're like, wow, I'm doing pretty good.
Okay, cool.
Uh, so that's kind of why you hear the dollar and the percentage, because the dollar is like what size of company is it?
Right.
Is it a small, medium, large company? Percentage is like, oh, how well are they doing? Just
Mm,
with their capital and their expenditures, because you're like, hey, it's 1 million EBITDA, 20%, awesome. It's 10 million EBITDA and 10%. You're like, oh well, the percentage is a little lower, but it's a lot larger
right.
company. There's a lot more expenses and
Yeah, yeah, yeah. Okay.
And
Yeah, that's
another thing, I'll throw in with the EBITDA. EBITDA doesn't always mean much to some people. Just because if you're not, a lot of times people are looking at it because they're trying to look for an exit, saying, "Okay, hey, I'm retiring soon." I'm not saying people should completely ignore it, but if you're just owning a company, you're growing it, and you don't really have plans for leaving it, it's not something to be too concerned about. But it is a guiding help, I guess you could say.
sure. Right. Okay. Now you mentioned a little bit earlier. I don't know if this is where you want to talk about it, but Mike, I have a question. So I know in my company, it seems like CFOs and CEOs usually work pretty closely together in
Yes.
a lot of ways, and so and at least in my experience, sometimes that's when you're going to merge with another company or those types of things. Obviously, you need to know the financials of your own company and the company you're trying to acquire or whatever. So when you do something like that, when if you're going to go take a loan or there's debt involved,
hmm
um, what kind of debt do companies have, and how does are CFOs the one managing that, or are they just kind of one of the people that are in the loop?
They will be one of the people, but they're gonna have a pretty big role in that because you're gonna bring legal involved eventually, obviously, just because you want to make sure the contracts are written appropriately and it's something that you can agree to. The CFO should have some idea of different instruments that are out there, different debt instruments or equity instruments, um, and I can explain the difference. Debt is kind of what you think loan. Even within
Okay.
that, there are some different types of loans that you can get. You can go get loans from a bank. You can go get a loan from a friend. You can go get a loan from a venture capitalist. These are debt. Like I said, that's what's considered debt in a company.
Mhm.
Something you owe that person. You can also get equity financing, which is uh, basically someone gives you money for owning a portion of the company. So if
Okay.
maybe you
Right.
don't want that debt because that debt means, oh, I have a monthly payment I need to pay and there's interest, and or you don't have a credit worthiness. Just like an individual, a business will go through a credit worthiness check. So a bank will look at, what's your revenue, how long have you been in business, Who owns the company? Do they have good experience of paying off debt or loans? Have they been bankrupt before? That will usually happen on smaller companies, not on your larger, bigger corporations. That's not, so
Sure.
if you're a smaller company and you want to go get a loan for the company, the bank might say, okay, I'll give it to you, but you, Carl, you're going to have a personal guarantee. So even if this company goes belly up, I'm going to come after you, Carl, for the money.
Right.
Um, Not always fun. So it's a risk. It's not. I'm not saying you shouldn't do it, but it's something obviously you want to consider
Be
heavily
careful with.
before
Yeah.
you just
Yeah.
jump into. And you're like, oh yeah, sure, $12 million loan. I'll personally guarantee it. So you have to be careful.
Yeah.
And if you don't want that, if you can't go get a bank, then you'll get equity. Like your best friend Joe Schmo, he's got money, and you go to him, and you say, "Hey, Joe Schmo, I've got this great business idea. This is what it is. I need $50,000 of seed money to start to kind of have a minimal viable product." And he goes,
Yeah.
"Yeah, sure, I'll give it to you, but I want 5% of your company." Oh yeah, no problem. The other type of people you'll go to that is like oftentimes it's people or relationships. Then there's angels investors, there's venture capitalists, and there's private equity. That's kind of the stage from small to large of where you'd go find your money, I guess. But every single one of those has their pros and cons, and every single one of them is going to ask for some sort of ownership and or control of the company. So they might
Mm.
be like that. Yeah, that's fine, but I want you to be co-CEO with this guy that I want to put in your company. So they want to make sure that their investment, because essentially what they're hoping for is that one day Carl's company will be so successful that he sells it and they get to make a whole bunch of money back.
Right.
That's their whole thing. Um, they're always looking for being able to sell their investment, just like in stocks and bonds. You hope the value goes up. Their
Right.
success rate, frankly, their success rate isn't very high. A lot of businesses don't do so well,
Sure. Sure.
unfortunately.
That's why they get to take so much of your business, right? Is that
Yep.
they have a low success rate, so they have to give out
Yeah.
a lot of loans, and when they
Yep.
strike it on one of them, they make a lot.
Yep. So that's the equity. The debt, like I said, is just like your loans where you're going to have to pay back money or there's interest. Even that within smaller companies, you might be able to get loans from people that are very favorable, low percentage. That you kind of like borrowing from your parents type thing. Like, hey, can I borrow a couple bucks to go to dinner? Now,
Right.
obviously, for a business, you can't just do it on a couple bucks, but same type of kind of idea. And I've seen that a lot with clients of mine where they know someone who's kind of funding and kind of their silent investor, I guess you could say.
Sure. Sure. So once that loan is formalized, then that obviously goes strictly in the in the accounting part. So the CFO is then in charge of it. But obviously the creation of that, or whatever instrument they want to use to fund the company, that's like a management level decision. And then once that
Yep.
decision's made, it gets handed off to your department.
Yeah, yeah. Well, the CFO will also be part of that decision, just so
Okay.
that they can be. It's advisable. I've been parses where it's not. Ultimately, depending on the company or how it's set up, just like single owner, they can just go and make their own decisions and they can do whatever they want. And I've seen that, and I've seen where they go get hard money loans, and it was against the advice of me personally as a CFO.
Yeah,
And it's like, hey, obviously
that's
you own the company, you could do it, but as a financial advisor for your company, this is a really bad idea because 40% interest is not a good idea. So,
true. I know
uh,
that.
yeah, it's sad because it happens sometimes. We all make dumb decisions. We all get in desperate situations.
Right.
Uh, but
Right.
I'm there to help kind of be the non-emotional, logical voice.
Right, right. Yeah, the numbers guy, literally the numbers guy.
Yeah,
So,
literally the numbers guy where you're like, "Look, this doesn't make sense. It doesn't pan out." "Oh, trust me, it'll work." I'm like, "Hey, I'm fine. I'm not saying it can't work, but the
right,
likelihood of it is very low."
right. Okay, so the other thing that I've seen personally, and the listeners of the podcast, so we've had a friend of mine, Mick McGurr,
Mm,
on the podcast a couple times over the last 4 or 5 years. He's a lawyer,
okay.
and his law firm is partnered with a um, uh, I to be fair, I don't actually know if it's a CFO. It's accounting services of some type.
Okay.
Um,
So they
and
do.
so
Okay.
yeah, so honestly, we would have to ask Mick exactly, but I know that tax law and
Oh yeah.
CFOs go hand in hand. So,
They can. Yeah.
how much does the CFO need to know about tax law, or do you just hand anything tax related off to an attorney?
So oftentimes tax won't go to an attorney unless if it goes to a tax attorney, you're really into depth, and you frankly, even a CPA that does taxes is gonna say no, go to a tax attorney. A lot of times you're bringing a tax attorney or attorneys when you're saying you're doing a mergers or acquisition, you're buying a company, or if you're a large company with lots of complicated investments, or you're international company. Yes, you're going to do that. Does the CFO need to know all of that laws, rules, and regulations? Luckily, no. Should they be familiar with it and understand it to some extent, and at least be able to have an intelligent conversation, and then to understand the consequences and then make decisions off of that? Yes. So the a lot of times your CFO needs, even though it's just a CFO, you've got to be a multi-hat individual. You've got to
Right,
understand a lot of a lot and be really good at a little bit. That's usually it's just putting it all together, reading between the lines, because sometimes you don't get all the information and you're trying to make decisions. And sometimes you're making decisions in the middle of a meeting and they want a decision and you're like, this is my advice. This is what I advise. I try to avoid those circumstances. I usually try to be like, okay, hey, what do we want to talk about? Let me plan. Let me put in some time before to plan. But yeah, they need to understand that, and to the point where they can have a discussion about it of how it's going to affect financials.
right,
And so the reason why they don't have to is a lot of times your CFO is more focused on the financial accounting and not the tax accounting of a company.
right.
But there
Exactly. Yeah,
are
that makes
but there
sense.
are times when tax is important. So you got to help. It's also good, especially if you're making money, to kind of as a CFO to bring in people that know taxes, because you're going to say, "Hey, this is great. We're making money." And this control and your tax guy is like, "Yeah, but you're going to pay taxes." And so you're like, "Okay, well, maybe what should we do? Maybe we should do some more investment or buy new assets or something to help mitigate your tax bill." So it is definitely part of the CFO's responsibility, but not necessarily what they have to be um, an expert at.
Okay, right. So the CFO like kind of interfaces with the tax attorney to figure out what's the best way forward, essentially.
Yep. Yeah.
Okay,
And I've worked in larger international companies where they actually have a tax department, where they have tax accountants and tax attorneys working in house, and they would report online up to the CFO.
okay. Okay, well then, okay, let's switch gears a little bit again. So what you
Yeah,
just said, like you said, CFOs have to know a bunch of trash,
it's
not
true.
not actually trash, but like stuff that you wouldn't assume a CFO needs to know. They have to have some familiarity with. There's just a lot to know and do. Um, what? So I mean, nowadays the thing to help solve that is software to some extent.
Oh,
So
very much.
what kind of software is there? What is there like an industry standard for CFO software, or what does that look like?
So I'm going to split it in two sides. There's your accounting software and then your financial software or reporting software. A lot of times, sometimes those are combined, sometimes they're separate. Accounting software, probably ubiquitous with most people. That QuickBooks, they hear QuickBooks. That is a very
Right,
common software. Those are usually your smaller companies, all the way up to you've got your NetSuites, you've got your, anyways, I'm just putting names, but you have enterprise level software as well, all the way
okay,
from QuickBooks to your enterprise level. And depending on what you're looking for, they're going to have different functionalities. And again, that's your kind of accounting, your history, where your data is. Then you'll have oftentimes at least a part of that, or built on top of it with the kind of with access. I can't even think what I'm trying to say right now. Where the financial software will pull that accounting software so you could do reports, because
okay,
there's always monthly, quarterly, and annually reporting to somebody,
right,
either the owner of the company, the board of directors. You're always reporting to someone. So that's when you start building your reports and you start looking and you start doing your analysis. You're looking at trends,
Right.
and there's software out there that helps you do that. That that helps consolidate and bring in the accounting software to help it to be more digestible. Nowadays, a lot of companies are going with integrating AI even into their accounting software to kind of skip financial software, and then there are financial softwares out there that are also adding AI. So they kind of uh, somewhat take your job away, but not really. There's still some, like, I've used AI in my job trying to review companies' financials so I can help better understand it,
Right.
and so that I can present to whoever I'm presenting to with good information. So yeah,
Yeah.
that's definitely what kind of the two splits are, and there is a shift into using AI more with that to help that. Not necessarily to get rid of your upper thing divisions, but a lot of times in larger corporations, the CFO will often be presented this information. You're not actually doing a lot of the legwork. You've got your financial analysts and different types of analysts that are doing these things, and they're presenting to you. You're asking questions, and then you're kind of taking it into and up to the board. You're often not in the weeds. I like to get in the weeds, and probably more so than I should. I enjoy it, frankly. So it's nice to get my hands dirty a little bit. And the
Sure.
reason, and oftentimes the reason is where the financial analysts, why you kind of have to have this too, is like I said before, a CFO will liaison with the different departments. So you're going to bring back information that they might not have been aware of when you see these numbers, and you're like, hey, that makes sense that we're going down. Sales told me that this was going to happen, or oh, sales told me something different. Why are my numbers different than what I was
Right.
told? And so a lot of detective work, and so you'll ask a lot of questions, and the finance guy will be like, hey, it's because of this, or you might ask the accountant, why what happened this month, and
Mm.
you'll get the answers. But yeah, so that's kind of the software package that you would use as a CFO.
Okay. Yeah, it seems like obviously nowadays in pretty much any industry, AI is making inroads, and like you said, you're already seeing it in your work.
Yep.
I'd imagine, obviously as the years pass, we're going to have a better idea of how it fits and what exact tasks you know it's going to be best at versus what a human in the loop is going to be useful for. But I'm
Yeah.
something that's going to continue to grow, right?
Yep. Yes, I think so. I don't think it's going to fully take away a CFO's job. It will
Yeah.
definitely make it faster and easier, is my opinion. Because like I mentioned earlier, a CFO is kind of a storyteller, and there are people that don't want to be told a story by a robot. They
Right.
they want it personalized, and
Yeah.
they want to talk to
Yeah.
someone. Because yeah, there are times I feel like I'm sitting there like, why do I have a job? Not necessarily why do I have a job, but like this can be read in a report. But then I also realized that, after so many years of experience, I can read the report. There's a lot of
Right.
owners out there that don't. They are relying on you to do the CFO job, and that allows them to do their job. And so you all have your place, and you're a piece of a puzzle, I guess you could say.
Yeah. Yeah. That makes sense. Um, okay. Two more questions for you, Jared.
Yeah.
One, you mentioned like obviously there are a lot of moving parts as a CFO and a lot of different reporting and financial, both accounting and then forward-looking financial um, reports that you run. How, like, with all of these numbers flying around, everyone's done math before, and all of a sudden you lose a number somewhere, a decimal place slips. But I imagine that's a big deal in company reporting and numbers.
Yep.
Financials. How
Yeah.
often do issues like that happen where like you're doing a report and there's a decimal place off and then suddenly you made only 1 million instead of 10 million?
Yeah.
Any anecdotal experience with that type of issue where and how often does it happen?
Yeah, so decimal points are very important. Can't share I won't share the experience, but
Sure.
yes, let's just say you've got to be very careful.
Right.
With your question, I'm going to introduce something that we use in accounting and finance is the term materiality. Is it material? Um, $1,000 for most individuals is a lot of money.
Yeah.
For a company that makes $1 billion a year, $1,000 is nothing. It's
Right.
not worth the time to worry about that $1,000. I know it's very hard. Um, because I work in accounting, I have a very different view of money and numbers because I have worked in large international companies that make 12 billion a year. And so it just frankly doesn't matter. I've been in places that and other companies that are so small that $100 is very important. I work for
Right.
clients like that, trying to help them grow their company. Because frankly, I work with companies from very small to medium sized
Yeah.
companies. Um, so that's the first kind of way to look at it is what's material for this company, and then
Mm.
at that point, is it worth trying to figure out what the difference is? And that's at different stages, you'll have different materialities. As a CFO, you're going to have a different materiality as you look at things because you're looking at the whole company than if you're an AR clerk or an AP clerk,
Mm.
someone that's processing the receivables and payables. You're going to have a different. I've been in places where they weren't allowed because they were a public company. That's another thing. If it's a private or public company, if you're a public company, you have more responsibility to those. You have a fiduciary responsibility to the shareholders.
Mm.
You really got to make sure those are closing on a daily basis. They're tying out. Um,
Right.
so yeah, as an accountant mind, you want everything to match to the penny. And there's a lot of steps in accounting that help it. Um, and so that's why you also go through audits is to check to make sure that your your finances is what they're saying is they're materially correct in all circumstances. You'll hear that materially correct. Where,
Mm.
hey, there might be some errors, but if there are errors, it's so insignificant that no one would make a different decision than they've made with these financials to either buy
Okay.
the company or invest the company. So it is important. Um, it can get frustrating also because when you run reports, going back to software, sometimes software isn't perfect.
Right.
Even though it's a very simple
I
idea
very
when you say, "Hey, I take," yeah, I apologize to a software developer. So, uh, there's black holes, frankly, in
yeah.
software sometimes where you
Yeah.
input numbers, and sometimes we make it to the complexity of the operations you're trying to codify inside of a software, and you might be off a little bit. So that's another thing where
Yeah.
I'm also the simpler you keep things, the easier it is to match. And there's lots of steps. There's daily, weekly, monthly, quarterly, and annual steps that we take to make sure that those things match and tie out. We get bank statements from the bank and say, "Hey, the bank says we have $1,000. What does my report say? It says we have $5,000. All right, well that's not true. Why is there a difference? Oh, it looks like we coded something wrong. Oh, that makes sense. Oh, we paid
Yeah.
someone too much. We paid someone not enough, or we fat fingered something. That happens a
Right.
lot. You're using your 10 key, you misplace the decimal, and a 3,500 becomes a $35,000. You're like, oh, well,
Hmm.
no wonder that was different, And it doesn't take much, but a 3,500 to 35,000, well, that's a huge difference.
Yeah. Yeah.
That quickly becomes material.
Yeah. I like that's
So
it. Yeah. That's seems like a very useful concept that you like the materiality of it. Because, like you said, like I've been in very small companies where, like you said, like if we lose $1,000, half the staff is getting laid.
yeah, yeah,
Where
yeah, yeah,
where like my current company, we're large enough that like something happens with the software that costs a fair amount of money, like we're going to be concerned, but we're not going to like no heads aren't going to roll. So
yeah. A- And like I said, at different levels, the materiality changes. So you ingrain into your accountants and stuff. No, it needs to match to the penny. And if they can get it to match to the penny, very rarely are they going to be off. And then you have a supervisor and an accounting manager that's reviewing their stuff and signing off. Then you have a controller above them, maybe an assistant controller, and then a controller that's reviewing work and making sure things are tying out. So there's lots of steps in the process to make sure you're close, but uh and so it's hard sometimes for people as they go through the ladder that way. It's ingrained in you so much to match to the penny, and it's frankly it's part of the personality of a lot of accountants, myself included. You get a
Right.
little OCD about it that you got to match to the penny. Uh, but then at some level, you got to realize, okay, if I want to take 2 hours to match to the penny, and I'm going to miss
Right.
my deadline to give my report, and I'm a controller, and my CFO is, breathing down my neck because he wants to go home. You're like, all right, this $10,000 entry isn't matching. Okay, just write off the $10,000, and that
Yeah.
$10,000 sounds massive, but you're like, I did $10 million in sales this year. $10,000 isn't gonna, or this month. That's $10,000 isn't gonna make a difference.
Right. Right.
So you just kind of have to weigh your things when you're in
Right.
your upper controller type management roles.
Yeah, it makes a lot of sense. All right, last question, Jared. So
Yeah.
you mentioned that you've worked on in like international businesses, and so we have international listeners here. Do CFO principles kind of? I mean, obviously tax law, that kind of stuff. That doesn't like different countries have different taxes, but
Yeah.
general financial principles and accounting principles. Those, I mean, those I'd imagine can be used across borders, in different countries. So as a CFO. And a multinational corporation oversee all the different countries, or how does that work?
Yeah. So yes, to keep it simple. Yes, those
Okay,
principles and stuff you get when you start getting into the technicality of how you record things in the books. There's a difference. So I mentioned GAAP earlier. United States follows GAAP, generally accepted accounting principles. The international community will not follow GAAP. They follow another code,
okay,
IFRS, which is International Financial Reporting Standards, if I remember correctly. Very similar idea though, because and the idea behind that is, or the reason they exist, is to help shareholders. So it's all related to public companies, but even if you're a private company, you're usually trying to follow these standards just because it's the standard. It's what people are aware of. That's what you're trained for in college, and so they're close enough where it's not too big.
okay,
But again, a lot of the times your CFO isn't really worrying about those types of things. The general idea of just being financially responsible, and helping the company make good decisions and make sure they have cash, make sure they have profit, and that's international. That's not going to be an issue. If I grew up doing GAAP. I have done IFRS, not much. I'm more acquainted with it than with a lot of knowledge. But frankly, a CFO is not going to be concerned too much about that type of stuff.
okay. Awesome. Well, you've been very insightful, and thank you, Jared. It's obviously that we cover lots of topics on these podcasts, and I am truly a layman in a lot of them, but this is certainly one where I know very little. So I learned a fair amount. So I appreciate your time, and so does the listener. If guys on that are listening online, if you have questions for Jared or financial, otherwise, you have our email. You can also comment on our podcasts and let us know what you think. And but yeah, thanks, Jared.
Yeah, no problem. Thank you for having me. It was a pleasure and very enjoyable. I'm always open to discuss anything finance and related. So
Awesome. Well, thanks, and we'll be back again next episode. So catch us then.